Hey everyone, welcome back to the Deep Dive. We're diving into the complex world of retirement plans today.
You're in the right place if you want to really understand how they work, what your options are, all that, without getting lost in the weeds, right?
Exactly. We've got a ton of material to cover, listener questions, and I'm sure some interesting viewpoints to unpack.
Yeah, there's a lot to consider when it comes to planning for retirement, and it's easy to feel overwhelmed.
So think of this deep dive as your shortcut. We've sifted through all the info to bring you the most important insights.
We'll break down the different types of retirement plans, highlight their core benefits, and really pinpoint the key things you need to know.
So to start, broadly speaking, there are two main categories we're going to be talking about today: qualified and non-qualified retirement plans.
Right. We're going to break those down, explain what makes them different, and why that distinction matters so much.
And then we'll zoom in a little closer and look at both the plans that are offered through employers and those that you can set up on your own as an individual.
Yeah, exactly. A lot of options to consider.
So first things first, let's tackle this whole qualified versus non-qualified thing. What exactly makes a retirement plan qualified in the eyes of the government?
So a qualified plan is basically any retirement plan that meets specific rules and regulations set by the federal government. And a big part of that is the IRS.
Like playing by their rule book, right?
Exactly. And in exchange for meeting these requirements, the plan receives favorable tax treatment.
Which is a pretty big incentive for both the company offering the plan and the employees participating in it, right?
Huge incentive. I mean, for employers, the contributions they make to a qualified plan are generally tax deductible.
So it lowers their taxable income.
Right. For the employee, though, the advantage is even bigger, I think.
In what way?
Well, you don't have to pay income tax on those employer contributions when they're made. And even better, the money in the plan grows tax deferred.
So it's like a double whammy of tax benefits.
Yeah. Your investments aren't being chipped away by taxes each year, so they can potentially grow much faster over the long term.
You only pay taxes when you actually withdraw the money,
Hmm.
usually during retirement. Makes sense. So then what about non-qualified plans? Why would an employer choose to go that route if they don't get those sweet tax breaks?
That's a good question. Non-qualified plans have more flexibility. They don't have to follow all those strict federal requirements.
So less red tape.
Exactly. This makes them useful for attracting and retaining key employees, often those in high-level positions.
I see. Sort of like a perk for executives.
Right, they can offer more tailored benefits to those select employees.
Can you give some real-world examples of non-qualified plans?
Sure, there's non-qualified deferred compensation plans. Sometimes you'll see them called supplemental executive retirement plans or SRPs.
Okay, so those are more focused on specific individuals rather than the entire workforce?
Yes, they're designed to supplement the benefits offered through qualified plans. There are also all sorts of incentive compensation plans that fall under this category.
So how do the tax implications differ for those non-qualified plans?
It's kind of flipped. The employer's contributions aren't usually tax deductible up front.
They get the deduction later.
Yeah, usually when the employee receives the money.
So it's delayed.
Yeah.
And the employee,
Well, the employee generally doesn't pay taxes until they actually get the benefits.
so it's a different timeline. Got it. Now let's shift gears and talk about those qualified employer plans.
Mm-hmm.
One thing that came up in the material is ERISA. What is that exactly?
ERISA, that's the Employee Retirement Income Security Act of 1974.
Okay, so a mouthful.
Ha ha ha, yeah. It's basically a set of rules to protect workers in pension and health plans.
It applies to both.
Yep. But we're focusing on retirement plans today. So under ERISA, there are all sorts of minimum standards these plans have to meet to be considered qualified.
And to get those tax benefits we talked about.
Absolutely. ERISA protects your interests, ensures the plan is managed fairly and transparently.
So what kind of protections are we talking about here? Give me the highlights.
First off, the plan has to be a formal written document, and it has to be communicated clearly to every employee.
So no shady backroom deals.
Right. Transparency is key. Also, it has to be for the exclusive benefit of the employees and their beneficiaries.
Makes sense. It's their retirement money after all.
Yeah. And it's supposed to be an ongoing arrangement, not something that can just disappear on a whim.
Okay, so it's pretty official.
Yeah.
What else?
Well, ERISA sets minimum standards for who can even join a plan. Generally, you got to be at least 21 years old and have worked for the company for a year.
Okay, so some basic requirements.
But there's an exception. If the plan offers what we call 100% vesting right away, then they can require up to 2 years of service.
Vesting, so that's when you have a guaranteed right to the employer contributions,
You
right?
got it. And new employees, They have to get a summary of the plan within 90 days of joining.
So they know what they're getting into. What about making sure the plan is fair to everyone, not just the higher-ups?
That's where the non-discrimination rules come in.
Makes sense.
ERISA makes sure plans can't play favorites and give way better benefits to executives while shortchanging lower-paid workers.
So it levels the playing field.
Exactly. The IRS actually keeps a close eye on this, making sure the plans aren't skewed towards those key employees, like executives and owners.
What about that actuarial determination of contributions thing? What's that all about?
That's mostly relevant to defined benefit plans, which we'll get to later. But basically, an actuary has to crunch the numbers and figure out exactly how much money needs to go into the plan to fund those promised future retirement benefits.
So it's about making sure the plan can actually deliver what it promises. Sounds important.
Oh, it's critical. ERISA also has rules about survivor benefits, making sure a surviving spouse is taken care of if an employee dies before retirement.
That's good to know. What about the vesting schedules we talked about earlier?
Right, so ERISA sets minimum standards for vesting. You either have to be fully vested after 5 years of service or at least 20% vested after 3 years. And then it gradually increases until you're 100% vested after 7 years.
So there are a couple of ways to get there.
Yeah. But either way, your own contributions are always 100% vested from day one. That money is yours no matter what.
Makes sense. And what about those top-heavy plan rules? What are those all about?
Top-heavy plans, that's when the benefits for key employees, the execs, the owners, make up more than 60% of the total plan value.
So basically, if the top dogs are hogging all the benefits.
Right. If that's the case, ERISA steps in and requires the plan to give minimum benefits to the non-key employees.
So it's another safeguard against unfairness.
Exactly. And another biggie, the law says plan assets have to be kept separate from the company's regular funds.
So if the company goes belly up, the retirement money is protected.
Precisely. Employees' retirement savings are shielded. And lastly, ERISA requires plans to file a Form 5500 every year.
What's that for?
It's a super detailed report on the plan's finances, investments, everything. It ensures transparency and accountability.
Makes sense. Seems like ERISA has a lot of bases covered.
Yeah.
Now, let's dig into the specific types of qualified employer plans, starting with defined contribution plans. What's the gist of those?
Defined contribution plans, they're all about contributions. It's mainly funded by the employee, usually through payroll deductions.
So I'm putting in my own money pre-tax.
Exactly. And your employer might chip in too, often by matching a portion of what you contribute.
And the cool part, I get to choose how my money is invested.
Yes. You usually get to pick from a range of investment options within the plan.
So I'm kind of driving the bus when it comes to my retirement saving.
Pretty much. And since the employer's main responsibility is just to make those contributions, it's a lot less risky for them in the long run.
Less administrative headache too, I'd imagine.
Definitely. But how much you end up with in retirement, well, that depends on how much you put in and how well your investments perform over the years.
So the growth is on me. But there are limits to how much I can contribute, right?
Yes, the IRS sets annual limits. It keeps up with inflation, though.
Now, the material breaks down three main types of defined contribution plans: profit sharing, stock bonus, and money purchase. Let's start with profit sharing. How do those work?
In a profit-sharing plan, your employer can decide to set aside a portion of the company's profits each year and distribute it to the employees.
So if the company does well, we do well.
Right. But the key is, those contributions aren't mandatory. They depend on how profitable the company is.
So there's no guarantee of a contribution every year.
Exactly. But the IRS does say those contributions have to be recurring and substantial over time.
Otherwise, it wouldn't really be a profit-sharing plan.
Right. And one more thing. If you take money out of a profit-sharing plan before you're 59 and a half, you might get hit with a penalty.
Ouch. So there's an incentive to leave it alone until retirement.
Definitely.
Now, how about stock bonus plans? How are those different?
They're similar to profit sharing in a lot of ways, but instead of cash, the contributions are made in company stock.
Interesting. So you become a part owner.
Exactly. You're literally invested in the company's success.
Makes sense. And lastly, we've got money purchase plans. What sets those apart?
Money purchase plans are kind of unique in that the employer has to make fixed contributions each year. It's all laid out in the plan document, usually as a percentage of each employee's salary.
So it's less flexible for the employer than a profit-sharing plan.
Yeah, they're committing to a set amount, regardless of how the company is doing.
So it's a more predictable contribution to the employee?
Exactly. And then you've got employee stock ownership plans, or ESOPs.
Right, those were mentioned briefly. What's the deal with them?
ESOPs are kind of cool. They're all about giving employees ownership in the company. Contributions are made in company stock, and those shares are held in a trust until the employee retires or leaves.
So it's another way to share the wealth, so to speak.
Exactly. Employees have a real stake in the company's success.
Okay, so we've covered defined contribution plans. Now let's tackle defined benefit plans. How do those work?
With defined benefit plans, it's all about the benefit. You're promised a specific retirement payout. It's usually calculated based on your salary history and how long you worked for the company.
So you know what to expect in retirement.
Yeah, you've got a guaranteed income stream. Think pensions.
So it's less about how much you contribute and more about a promise of future income.
Exactly. And the employer is the one responsible for managing the investments and making sure there's enough money to pay out those benefits.
Sounds like they carry a lot of responsibility.
They do. If the investments tank, they still have to pay up.
So it's a bigger risk for the company.
Yeah, definitely. And as an employee, you usually don't have much control over how the money is invested until you actually retire.
So what makes a defined benefit plan qualified in the eyes of the IRS?
Two main things. First, the benefits have to be definitely determinable. There's a specific formula or actuarial calculation that determines your payout.
So no ambiguity there.
Right. And second, those benefits have to be paid systematically over time, typically for the rest of your life.
Sounds good to me. So the employer is making a long-term commitment.
Exactly. Now let's move on to another really common type of plan. Qualified salary reduction plans. Think 401ks and 403bs.
Ah, yes, the 401k.
Yeah.
It seems like everyone's got one of those.
They're super popular. Basically, a 401k, which is also called a cash or deferred arrangement, lets you reduce your current salary and have that money go directly into a retirement account.
So I'm choosing to save a chunk of my paycheck before taxes.
Exactly. And that money grows tax deferred.
So it's like getting a tax break now, and then my investments grow without being taxed every year.
Right. And a lot of employers offer matching contributions. That's basically free money.
Free money is always good.
It really boosts your retirement savings. Now, of course, there are limits to how much you can contribute each year.
The IRS steps in again.
Yeah, they set annual limits. But if you're 50 or older, you can make an extra catch-up contribution.
Nice little bonus. Now, what about 403b plans? Are they basically the same thing as a 401k?
They're similar in a lot of ways. They both offer pre-tax contributions and tax-deferred growth, but 403b plans are specifically for employees of nonprofit organizations like schools, charities, religious groups.
So not for us corporate folks.
Right. You can fund them through employer contributions or through your own salary deductions.
Makes sense. And the material also mentions Section 457 plans. Who are those for?
Section 457 plans, they're mostly for state and local government employees and some nonprofit folks.
Okay, so public sector.
Right. Similar to 401ks and 403bs, you defer a portion of your salary, don't pay taxes on it now, and it grows tax deferred until retirement.
Got it. Seems like the government really wants us to save for retirement.
Well, it's in everyone's best interest.
Now let's talk about qualified plans specifically for small business owners. What are their options?
Small business owners had it kind of tough for a while. They could offer these plans to their employees, but it wasn't so easy for them to participate themselves.
Because they're the employer, not technically an employee.
Exactly. Same problem for self-employed individuals. But then Congress passed the Self-Employed Individuals Retirement Act of 1962.
So they finally recognize this issue.
Yeah. This law allowed small business owners and the self-employed to be treated as employees for the purpose of retirement plans. And that's what paved the way for KEO plans.
Which are sometimes called HR 10 plans.
Right. A KEO plan is designed specifically for unincorporated businesses and self-employed individuals.
So now they can participate in their own plans.
Exactly. They can be either defined contribution or defined benefit. In the early days, there were some differences between KEO plans and corporate plans, but now they're pretty much aligned in terms of rules and regulations.
Makes things simpler.
Definitely. And then you have simplified employee pension plans, or SEPs. They're all about, well, simplicity.
As the name suggests.
Right. Setting up and managing a traditional qualified plan can be a real hassle for small businesses, lots of paperwork and costs.
So SEPs streamline things.
Exactly. With a SEP, the employer contributes directly to a traditional IRA that's set up for each employee.
And that includes the owner, right?
Yes, everyone benefits. And a big plus, those employer contributions are excluded from the employee's taxable income.
Nice tax break. Anything else noteworthy about SEPs?
Yeah, they have higher contribution limits than regular IRAs, but just like other qualified plans, they gotta follow those non-discrimination rules.
So no playing favorites.
Right. And then there are simple plans. That stands for Savings Incentive Match Plan for Employees of Small Employers. Another mouthful.
Haha, seems like retirement plans love acronyms.
You're telling me. So simple plans are for businesses with 100 employees or less, and they're designed to be even simpler and cheaper to set up and run than SEPs.
So even less hassle for small businesses.
Exactly. With a simple plan, you can either have a simple IRA or a simple 401k.
Oh, interesting. So it mirrors those other types of plans.
Right. And a key feature is that all contributions are immediately 100% vested.
So the employee owns those contributions right away.
Right. No waiting period.
That's great. Anything else about simple plans?
Yeah, there's an eligibility requirement. Employees need to have made at least $5,000 in the previous year to participate.
And the employer can't have another type of qualified plan already in place, right?
Yeah, exactly.
Huh.
Simple plans also allow those catch-up contributions for folks 50 and over.
So that's a consistent theme.
Definitely.
Okay, so that's a good rundown of the qualified plans for small businesses. Now let's move on to those individual retirement accounts, the IRAs. What's the main difference between a traditional IRA and a Roth IRA?
The main difference is when you pay taxes. With a traditional IRA, your contributions might be tax deductible.
So I could get a tax break now.
Exactly. Then your money grows tax deferred and you only pay taxes when you withdraw it in retirement.
So I'm kicking the tax can down the road.
You got it. Anyone under 72 with earned income can contribute to a traditional IRA. There's also a spousal IRA for non-working spouses.
That's nice.
Yeah, it allows couples to save more. And of course, there are annual contribution limits.
Set by the IRS, right?
Right. And with traditional IRAs, you've got to start taking those required minimum distributions, or RMDs, once you turn 72.
So you can't just leave it all in there forever.
Nope. And there's usually a 10% penalty if you withdraw money before you're 59 and a half.
Unless you qualify for an exception.
Right.
So with a traditional IRA, you might get a tax break now, but pay taxes later. What about Roth IRAs? How do they work?
With a Roth IRA, it's the opposite. You contribute after-tax money.
So no upfront tax deduction.
Correct. But the cool thing is, if you make a qualified withdrawal in retirement, all that money, contributions, and earnings is completely tax-free.
So you pay taxes now and enjoy tax-free income later.
Exactly. And there's no age limit for contributions, though there are some income restrictions.
So if you make too much, you might not qualify.
Right. The contribution limits for Roth IRAs are the same as for traditional IRAs.
And unlike traditional IRAs, there are no required minimum distributions during your lifetime.
That's a big plus. You can let that money grow tax-free for as long as you like.
You mentioned spousal IRAs and rollover IRAs earlier. Can you explain those a bit more?
Sure. A spousal IRA is for a working spouse to contribute to a separate IRA for their non-working spouse. It allows couples to save more, even if one spouse doesn't have earned income.
That's pretty helpful. What about rollover IRAs?
A rollover IRA is basically a way to move money from another IRA or a 401k into a new IRA without paying taxes.
So you can consolidate your retirement savings.
Exactly. It keeps those savings tax deferred, and a surviving spouse can even roll over inherited benefits into their own rollover IRA.
So it provides some flexibility.
Definitely.
Okay, last but not least, let's touch on those qualified educational savings plans. We've got education IRAs and 529 plans. How do they work?
Education IRAs, also known as Coverdell Education Savings Accounts, can be used for pretty much any kind of education expense, from kindergarten to college.
Wow, so it covers a wide range.
Yeah, and if there's money left over, you can roll it over to another beneficiary in the family before the original beneficiary turns 30.
Handy. What about 529 plans?
529 plans are specifically for college and other post-secondary education. They're run by the states.
So each state has its own plan.
Right. There are two main types: college savings plans and prepaid tuition plans. And similar to Roth IRAs, earnings and qualified withdrawals are tax-free.
So a nice tax advantage for educational savings.
Absolutely.
All right, I think we've covered a ton of ground here. We've talked about the key differences between qualified and non-qualified plans, all the different types of employer-sponsored plans, and those individual retirement accounts. plus those education savings plans.
It's a lot to take in, but hopefully now you have a much better understanding of your options. The key takeaway is that there's a whole range of plans out there, each with its own pros and cons, designed for different needs and situations.
And having this knowledge is so important for making informed decisions about your future financial security.
Absolutely. Don't just go with the default option. Do your research, understand the different features and tax implications, and find the best plan for you.
And on that note, I've got a question for you, listener. We've talked about all these tax advantages, employer matches, flexibility, and guaranteed income. What's the one feature of a retirement plan that matters most to you and why? Think about it and maybe do some more research on your own. Thanks for joining us for this deep dive into retirement plans. We'll catch you next time.